Okay, guys, so we are going to look at together problem 12 or 2-26A. It's on page 113. I encourage you to try this on your own without looking at the problem answer key or my discussion and see how you do, and then come back and revise your answer, seeing where your weaknesses are and your strengths, and see if you have any questions. Frøya Fabrikker AS of Bergen, Norway is a small company that manufactures specialty heavy equipment for use in the North Sea oil fields. The company uses a job order costing system and applies manufacturing overhead costs to jobs on the basis of direct labor hours. Its predetermined overhead rate was based on a cost formula that estimated $360,000 of manufacturing overhead for an estimated allocation base of 900 direct labor hours. The following transactions took place during the year. All the purchases and services were acquired on account. So we are going to look through each of these, and as we're going through, we're going to prepare the journal entries. In A, raw materials were purchased for use in production. So we will debit the raw materials inventory account, $200,000, credit accounts payable, $200,000. Raw materials were requisitioned for use in production, all direct materials, $185,000. So remember, when they're requisitioned to be put into production, we move the cost of those direct materials or indirect materials even out of the raw materials account. They're no longer in raw materials inventory. So we credit raw materials inventory account, debit the work in process inventory account for the cost of those materials. In C, utility bills were incurred. $70,000. 90% relate to factory operations and the remainder relate to selling and administrative activities. Well, then 90% of the bill, or $63,000, will be debited to that manufacturing overhead account, which is just a transfer account. I'm trying to think of the word. But actual manufacturing overhead is debited to that account, applied as credited. Okay, and that's the way you want to look at it. The portion that is not related to manufacturing is debited to utility expense, $7,000. Credit accounts payable for the $70,000. Salary and wage costs were incurred. Direct labor, 975 hours, $230,000. Indirect labor, $90,000. And selling and administrative salaries, $110,000. Well, you will debit the work in process inventory account for the amount of direct labor hours for the production process, $230,000. You'll debit manufacturing overhead, the $90,000, because it's actual cost of overhead. And then debit salaries expense, $110,000, because that's just a normal expense. Doesn't have anything to do with the production process. Credit salaries and wages payable for the total amount of $430,000. Maintenance costs were incurred in the factory of $54,000. We'll debit the manufacturing overhead T account, $54,000. Remember, all actual manufacturing overhead costs are debited to that account. When we apply the overhead, we credit that account. And we credit accounts payable. In F, advertising costs were incurred, $136,000. Well, those are selling expenses, so we'll just debit advertising expense and credit accounts payable. Depreciation was recorded for the year, a total of $95,000. 80% relate to factory equipment and the remainder to selling and administrative equipment. So 80% of the $95,000 or $76,000 will be debited to the manufacturing overhead T account. The remaining $19,000 will be debited to normal depreciation expense, and then we'll credit accumulated depreciation for $95,000. In H, rental cost incurred on building is a total of $120,000. 85% relates to the factory operation, the remainder related to selling and administrative facilities. So again, we'll take $120,000 times 85%, debit the manufacturing overhead account. We always debit that account when we have actual manufacturing overhead. We debit rent expense for the remainder and credit accounts payable for $120,000. In I, manufacturing overhead costs was applied to jobs. Well, now you have to figure that out. So remember, they said they use a predetermined overhead rate. We'll take the estimated total manufacturing overhead cost, which was given in the problem as $360,000, divided by the estimated total direct labor hours, which were 900. So the predetermined overhead rate would be $400 per direct labor hour. The actual direct labor hours given in Part D are 975. So 975 times 400, we will debit work in process or apply 390,000 of the manufacturing overhead to work in process, and then credit the manufacturing overhead T account 390,000. In J, cost of goods manufactured for the year were 770,000. So the cost of goods manufactured means that's how much is finished being manufactured. We debit the finished goods inventory, credit the work in process. Take the cost out of work in process because it's no longer work in process, it's a finished good. And finally in K, sales for the year, all on account, totaled $1,200,000. So in the first part of our journal entry, we'll debit accounts receivable and credit sales for $1.2 million. These goods that were sold cost $800,000 according to their job cost sheets. So we debit the expense account cost of goods sold for the cost of the goods that were sold and decrease the finished goods inventory account because they're sold for the $800,000. So that's a great review and taking a look at all the journal entries required for the typical manufacturing of a good in a job costing system. Now in the next part, and I know this is very small and I do apologize, they ask us to post each journal entry to the respected T account so you can see it flowing through the general ledger. So let's take a look at each one. In A, we debited raw materials. Oh, by the way, they tell us underneath that the balances in the inventory accounts at the beginning of the year were raw materials 30,000. So that T account must start with that balance. Work in process had a $21,000 beginning balance, and finished goods had a $60,000 beginning balance. They even tell us in part 2, don't forget to put those in there. Now we can start posting each of those T accounts we just created into their respective accounts. So there's our first one, debit raw materials, inventory, credit accounts payable. In B, debit work in process inventory 185,000, credit raw materials, and that B should be up one line next to the 185,000 credit for raw materials. The next, we will debit manufacturing overhead 63,000, utilities expense 63,000, and credit the accounts payable 70,000. In D, sorry about that, we are debiting manufacturing overhead for 90,000 and sorry. There we go. 90,000. We're going to debit work in process 230,000, debit salaries expense 110,000, and then credit salaries and wages payable for the 430,000. In E, we debited manufacturing overhead 54,000 and we credited accounts payable 54,000. In journal entry F, we debited advertising expense 136,000, credited accounts payable 136,000. In G, a debit to depreciation expense of 19,000, a debit to your manufacturing overhead T account, $76,000, and then a credit to the accounts payable T account, $95,000. In H, we debited manufacturing overhead, $102,000, debited rent expense, $18,000, and credited accounts payable for $120,000. In I is when we applied the manufacturing overhead by debiting work in process, $390,000, and crediting the manufacturing overhead account, $390,000. In I, we debited work in process. Sorry, that was I. In J, we debited finished goods, $770,000, and credited work in process, $770,000. K, we debited accounts receivable for $1.2 million, credited the sales T account, $1.2 million. We then debited cost of goods sold, the expense account, for $800,000, and credited finished goods, $800,000. So that is how all the T accounts would have been affected by our journal entries. Now, what you can do next is find a balance in each T account. So we would have, they don't have them there, so let's do them ourselves, right? In the raw materials inventory, oh, come on. Pain in my doobie. There we go. 30,000 raw materials in the debit plus 200,000 and for, oh, it does have the balance, I'm sorry. And 200,000, 230,000 would be your debits. Subtract your credit of 185, it gives you a balance of 45,000 in raw materials. Work in process, the balance would be 56,000. Add up your debits, subtract your credit, balance 56,000. Finished goods, you'd find the balance the same way. Has a debit of 30,000. Now, the accumulated accounts payable, wages and salaries payable, we don't need those accounts. We're not going to use them, but they're there. You should find the balance in them. Sales are 1.2, cost of goods sold 800, manufacturing overhead. When we add up the debits, subtract the credits, we have a credit balance of 5,000. So it looks like we over applied our manufacturing overhead. We applied more than the actual. And each of the other expense accounts only has one item in it, so that is their balance. Now, in the real accounting world, we would then create a trial balance using this information to create our next step, which would be a schedule of goods, cost of goods manufactured. And this is the one in the voice PowerPoint we saw a flow chart of, but we didn't actually do one. So now we're going to use the information from our journal entries and our T accounts to create this cost of goods manufactured. And what we're looking to do is add the direct materials we actually used this year, plus the direct labor we actually used, plus the manufacturing overhead used. And we're going to add that to our work in process that we started with. If we add all those three costs we added during the year, that'll give us all the costs of everything we could have finished this year. Well, there's going to be certain things we didn't finish, so we got to figure out those costs, and those are the ending work in process amounts. They're subtracted to get our cost of goods manufactured. Now, okay. So our raw materials began the period at 30,000. That was given. We purchased more raw materials of 200,000 to give us 230,000. The ending balance in our raw materials T account is 45,000. So the materials that were put into production this year were $185,000. The direct labor was 230. We could just trace that amount. Manufacturing overhead applied was 390,000. So the total manufacturing costs that were incurred this year are 805,000. Now, we add that amount to the beginning work in process balance. What costs were there in the beginning of the period for the goods that were started but not finished yet? We add those two amounts together and we said if everything was finished at the end of this period, the cost of goods manufactured would be 826,000. but they weren't. There were still some goods that were started but not finished yet. And that was the ending balance in our work in process T account, $56,000. So we subtract that. The actual cost of the goods that were manufactured this year in total were $770,000. We over-applied our manufacturing overhead. So we have to do another journal entry where we debit manufacturing overhead and credit the cost of goods sold. So you should update your cost of goods sold T account for that. Now, how do we get cost of goods sold? Well, one way of doing that and creating a schedule to determine the total amount besides your T account is start with your beginning finished goods inventory. So if you sold everything this year, or I'm sorry, if you sold everything that was in beginning inventory, it cost $60,000. But you manufactured more stuff and finished it. $770,000 was the cost of those items you just determined. So if you sold everything you could have this year, the cost of those items would be $830,000. But you didn't sell all those items because in your finished goods inventory account, you still have $30,000 of costs left. So how much did you sell? Goods that cost $800,000. Now remember, we had to decrease cost of goods sold because we expensed too much manufacturing overhead this year due to our predetermined overhead rate. So our actual cost of goods sold will be $795,000. Now, the next requirement asks us to make an income statement, a normal everyday income statement that will be given to our decision makers. We'll use the items that we have in our T accounts. So we have the sales of $1.2 million. If you post that journal entry from the previous slide, your cost of goods sold account will have a balance of $795,000. Subtract that, that'll give you your gross margin or gross profit. Now add all the expenses, selling and administrative expenses. Subtract those from your gross profit or gross margin and your net operating income, how much you made purely from operating, $115,000. So that's a great practice of the income statement, just like that other one was a great practice of the cost of goods manufactured schedule. The final requirement wants us to, let's read that. Job 412 was one of the many jobs started and completed during the year. The job required $8,000 in direct materials, 39 hours of direct labor at a total labor cost of $9,200. The job contained only 4 units. If the company bills at a price of 60% above the unit product cost on the job cost sheet, what price per unit would have been charged to the customer? Okay, so we're going to take the $8,000 in direct materials and $9,200 in direct labor. We'll take the 39 hours times the predetermined overhead rate of $400 an hour. So the total manufacturing costs would be $32,800. So if you take 60% of $32,800, $19,680, add that to the manufacturing costs, that's what was charged to the customer. Divide that by the 4 units that were produced by this, $13,120 would have been the charge per unit to the customer. Okay, so please try that problem on your own if you didn't already, then come back and look at it again and post any kind of questions you may have to the discussion board.